actually since you guys are famous. I mean, I see your television crew was here this morning, and it was here earlier in the week. This is getting to be, it is the end spot for really startups and a lot of good technical action in the Valley. I've been around for 3 or 4 years, and I think I know where a lot of the others are, but this one I think is clearly outstanding. So I hope you can keep it that way. Thanks for inviting me. Just a bit on my background. I actually had a career with IBM first, started out in actually marketing, sales, and technical support, and then actually got into programming management. So I've written a lot of code in my time, but sort of forgotten about that to some extent, even though every so often I turn into an actor again. I was actually in Boca Raton, Florida during the development of the IBM PC, so that's my claim to fame, is I love PCs. I know everything about it. I managed PC DOS development for a while, even worked with Bill Gates when he was a regular guy. He kind of went on into a whole different world. But at any rate, it gave me a whole kind of perspective of the business, and I ended up moving to Silicon Valley. I joined startups there. Unfortunately, not the big successful ones. Sometimes you learn more from unsuccessful ones than the successful ones. But I was able to get a little better insight as to how this whole venture capital thing works, how startups work, which ones tend to succeed, which ones don't. So when I moved here for family reasons about 3 or 4 years ago, I decided to really get involved in the business side more than the technical side. So I ended up joining the Arizona Angels, and I've done quite a bit of work with ASU, the Technopolis program. I've been over to Thunderbird and done business plan judging. So I've had pretty good exposure to the kind of things that are going on here, and pretty good understanding, I think, of how the investment process works. Actually, the first question I always get is, what is an angel? What's an angel investor? The simple answer to that is that an angel investor is somebody who invests his own money, as opposed to VC, venture capitalists, who invest somebody else's money. They end up with funds which they can manage. But when you're investing your own money, you do it a little differently. And it actually is both good and bad. It's good in the sense that if you get an angel investor, he's probably at least willing to help you. He's willing to help you even maybe sometimes more than you want help, or it depends on where you are, what your views are. But I think the whole issue about angel investors is find one that has a chemistry match with what you're trying to do, because this isn't somebody who's going to hand you $1 million or some amount of money and then say, go do it, I don't care. It's not likely to happen. Angels invest locally. They invest where they can touch and feel what they're involved with, and they typically invest in things where they have domain knowledge, which means maybe they're software types investing in a software company, or clothing store types investing in retail, that kind of thing. And so that's the key part of it. Another part is that angels typically are people that are trying to do a little bit of give back. They're trying to, they've had a successful career, maybe made a bunch of money, and they're saying, I'm willing and interested in helping somebody else be successful. And so they're looking for somebody that they can mentor, somebody that they can believe in, which can lead to success. Everybody wins when you have success. So that's really what angel investing is all about. I started like a year or so ago trying to really understand some of the new startup things like social and networking, because we're getting a lot of proposals on that. So I'm actually an active blogger. I write a blog every day on entrepreneurs and startups, and I am involved in LinkedIn, Twitter, Facebook, MySpace, and 2 or 3 others, although that's only the beginning. There's millions of them out there. So I get a lot of feedback even every day. I have something like 70,000 followers on Twitter, so I get a lot of questions because I ask people, send me your business plan, or ask me any question, I'll take a shot at it. So I'll extend the same offer to you. Ask me any question, business plans, whatever you because I have a degree in accounting as well as a degree in computer science, I actually can kind of balance the two of those and go some people along the way. So, any questions before I really start here? I have to keep it informal. Anytime you have questions, just let me know. I'm just going to try to ease into this. First of all, where is angel funding in the whole scheme of things? It is not what I recommend as a place to start. Everybody should build their own company. It's called bootstrap. It means fund it yourself. I guarantee you that's the least trouble and the most satisfying. It's the least trouble because almost any other funding takes a lot of work. A lot of work on the part of the CEO, CFO, all the players, a lot of documentation. Bootstrapping means you can do what you want, you own it, there's no problem. And of course, then you're responsible. The second level is you say you need money, and in fact, angels will tell you must go through these stages. In other words, you can't go to angels without going through this. This is go bring somebody else in. This is one of the first questions you would get at an angel meeting if you were trying to present us. What skin do you have in the game? And that says, have you put in bootstrap money in? Have you pulled in your friends? And the answer better be you have some skin in the game, because if you're one of these guys that sometimes we get people who are a little arrogant, I'll say, you say, well, I don't want to risk any of my own money. So I'm looking for you to put in money. That doesn't go very well. It doesn't go very well. People say, we'll come in if you are so confident that you put in everything you can, you've dragged in everybody you know. And the second thing that this does is it gets you a little further down the road. Most investors don't like nothing. They don't like early stage. They like to see the product that's in prototype or beta. They like to see that you've got a customer revenue stream. So they're looking for things. Now I'll go through a couple here which may or may not apply. Grants are hot these days. Let me tell you, everybody and his brother is applying for a grant. And rightly so, because Obama says we have $4 billion for grants, especially if it's anything to do with energy, alternative energy, or green, or half a dozen other things. If you aren't applying for a grant, you're probably missing the boat. The good thing about a grant is if you get $1 million grant, you don't have to give up any portion of your company to get it. There's almost, once you've gotten it, the rules are pretty clear. You don't have to do anything. These are best done probably through some connection to the university or something where people know how to apply for grants, maybe they'll write it up for you and get a chunk of the loans. Everybody knows what a loan is. Then there's startup incubators. In a sense, this is an incubator. So an incubator is more thought of as an organization that you can use for resources, but many of them will actually give you or help you invest. In other words, they might put in $10,000 or some small amount. So that's an alternative to get money. Now we're getting to angel investors. So if you pass those, how you think about angel investors are local. So I'll go into that further. But after angel investors are venture capital. One of the keys here is angel investors typically won't invest more than, say, 20 or 50,000 individually, and as a whole, if you need more than $1 million, angels are out. They typically only do low-end, smaller numbers. If you're looking for a couple million or 10 million, it's venture capital territory. Now, let me tell you, venture capital has both good and bad as well. The one is there's not much around this part of the country for some reason. This area, Phoenix, well, it's a big metropolitan area, hasn't done well in terms of having venture capitalists funding. There's almost no offices here. Some people say that's because the state isn't very friendly to VCs. It doesn't give them office space and incentives and everything. And we don't have any big government installations nearby that are kicking out all kinds of ideas that VCs might invest in or something like that. So we're not really big on VCs around here. Now there's some Here's 8, 9, and 10 are kind of the other alternatives. If you don't make it on these bartering, that just means trade services for wealth or investment. Strategic partner, this is actually a good one. And a lot of people save their company this way as they go to a company that needs you. Let's say you have a startup and you do processing of medical forms or something. And you're dreaming that you're going to be the next Med Health or something. And so you finally realize that you want to get your $10 million. If you can find a big company that needs your service badly, they'll probably kick in a couple million. Maybe you do a white label thing for them. In other words, they foster your startup, and you can target them. Eventually, you say, I'll be independent. Eventually, but initially, they are my partner. They have ownership. Well, a slight variation on that is where they are your customer. You know, a while back, I knew the CEO who had a pretty good sized software company. He says, we have never spent a dime on software development of our own money. We just go to our best customers and we say, hey, we'll do this next product with you as the number one recipient, and we'll make sure it matches all your requirements. But we need $1 million or something for you to kick in, which you'll get back over time by deferred or taking out royalties. And so if you are good, you can convince your customer that you're going to do what he wants and he's going to get it first. He's likely to be working on something as well. So that's kind of the top 10 funding approaches for startups, which questions. Now, this is kind of an aside. I want to kind of give you some things that I see that people do wrong. These are tips on what to avoid if you're getting ready for any kind of funding or any desire. I wrote an article I like. It says, people say things like, well, business plans are for dummies. That means I don't need a business plan. I know what the business is going to do. That's a red flag. These are all red flags. It says this guy isn't serious, or he doesn't understand business, or he's arrogant. You need a business plan for every business for your own use. For your own use, meaning you tell yourself what you're going to do, provide yourself some measurable kind of basis, and then do it. If you're going to go to an investor, you really need an investment-grade business plan, which has a little more stiff criteria to it, but it's really for the same purpose, and that is to tell somebody else what you are going to do in a convincing way that shows that you've done the homework. So don't fall for that. Here's another one I hear all the time. We have truly disruptive technology. Now, I'm going to speak to you from an investor kind of perspective here. The first thing I hear when you say I have disruptive technology is this is brand new. And I think this is going to take a long time. Disruptive technologies, number one, don't happen fast. It's going to take 10 years. And it's going to take a lot of money. And I'll never see a return on in my lifetime. So, you have to be careful about how disruptive or how far out you position your technology, and make sure that you don't steer away from the track. This is another one that's kind of an attitude. It says, hey, this is so great. My product is so great. If I build it, everybody's going to want it. It doesn't work that way. It doesn't matter how much you love the product. Not necessarily will everybody else love it to the same degree. And the fact is there's a billion websites out there. And so I see this all the time. People create their website and their product offering, and they kind of sit back waiting for the world to descend on them. It doesn't happen. It's like you're hidden in the bayous of Louisiana or someplace, and everybody's looking there. You have to go out and drag people in or find something. So I got such disruptive technology, there are no competitors. I can't find anything. Well, an investor's answer to that is, okay, that either means you haven't looked, or you're stupid, too stupid to realize that there are always competitors, or, in fact, there's no market. If there's no competitors, that means there's no market. everything that people want, somebody that's tried to do, and in fact, there's always an alternative way. So, in your business plan, that statement, you have characters is a big red flag. It's hard to invest in companies. There's another common kind of thing. This is, okay, in fact, I got a proposal like this just last week. I have the best new social networking site ever, and combines all the good things of Facebook, MySpace, Twitter, and it's got more features than anyone, and therefore everybody's going to want it. That's actually not often true. It's not often. It doesn't work because if you try to do too many things, you don't do any of them as well as the ones that are out there. And number two, people don't like to change. And so if you aren't offering a lot new, getting people to get off of what they have and on something else for one more feature or two more features isn't going to happen. So tell me you got more features than anyone. That won't risk. This one I already covered. I don't want to risk my own funds. I'm going to go for VCs. When people finally, after months of fighting for money, say, hey, we got our money, now we can relax. It turns out that's only the beginning, of course, and that's when you have a little bit of work. You got to make sure you meter it out carefully, all those kind of things. The last one here is one of my favorites. I'm the founder. Nobody can run it better, which boils down to an ego kind of problem. I've written a couple articles about this. People who go for venture capital money often run into the situation where the VC says, okay, I'm interested. I'd like to give you $1 million, but I'm going to have to bring in my own CEO who's got a lot more experience than you. My friend who is oh no, it's my company. I can run it better than anybody. I'm going to go find another VC. After about 3, his credit card ran out and his company closed. In other words, you have to be a little bit humble. This whole game is about how do you make a success out of your business, and it's very reasonable to kick yourself up to chairman of the board or something like that, get out of the way, and let somebody else run the company if it's worth it. If it's worth it, you've got to make that trade-off. If you have your own millions, don't worry about it. You get to run your own company. But there are a lot of other issues here that are hidden. It's what I call founder syndrome. About that. Founder syndrome is when it says, I don't listen. I don't listen to anybody else. You've probably all seen people, met people, maybe have worked with people who say, hey, I want an advisor and I want you to tell me what you think. Listen, but as soon as you say one word, they're already there with the answer, and they aren't really listening to anything. And in fact, no matter how hard you make the case, they do what you want anyway. Somebody has seen it. Okay, so now we're into how do you get ready for any investors, but angel investors in particular. Actually, the same exact rules apply to venture capital investors. You need an investment-grade business plan. I'm going to show you an outline in a minute. You need an executive summary, which I actually think these days what investors look for or react best to is what I call a 2-page glossy. This is maybe 1 page, both sides, with nice columns, and basically it's a marketing piece about your startup that has everything that's in the business plan netted out. And don't give me an executive summary that's 10 pages long. That won't get read. Don't give me one that is your elevator pitch, that's 3 paragraphs. That probably isn't going to tell the story. This has got to talk about all of the essence of competition, market research, product description, what problem it solves, financial projections, so forth. And then the third thing is investor presentation. This is what you use to, that's really the first thing that as a group angels would see. It's equally important. This PowerPoint presentation has got to show all of those things that are in your business plan. There's a format for it as well. It's not that hard. It's easy to spot when it isn't there. I'm actually on the selection committee for the Arizona Angels, so I get to see all the presentations first on paper, and then I get to hear the first ones that they pick. Half a dozen is pick. A couple go in front of the Angel group each month. And after you've seen dozens of these, it's not hard. So again, you have to stand out. You don't want to stand out by having big holes. Last thing there is a financial model. That's something you need. It's pretty rare that an investor will look at it just almost into final closure. It talks about all of your costs, your revenue sources, with some parameters, modeling parameters, to say, what if I see the market grow 10% less than I expected, or what if I pay 10% less than recalculate, those kind of things. So it looks like you've done analysis. It doesn't ever come true. Because I haven't seen a financial model yet that anybody has yet. But if you've not thought about it or done this, you're even less likely to meet anything that you say that's fictional.
Do you use AngelSoft?
Yes, we do. I'm going to show you. AngelSoft is the entry point for Arizona Angels and most angel groups. So this is a simple outline. These are 8 sections, and you better have all of these sections, or at least cover the same thing. This is just a summary of all of these. This one is the most important. It's the very first thing you read. Now, let me tell you, I read business plans several per week, and several per day on the speed reader, so I go through the business plan fast. And the first thing I look for is, what's the problem that your startup is addressing? You can't believe how many plans start out with, here's my solution, here's my technology, it's the greatest new platform. When I was just looking at it, so this is a great new platform for M&A business, just businesses that buy other businesses. And you go through this whole thing, and you're like, what's the problem? It's been, people have been buying and selling businesses for hundreds of years. It never once said, the problem is it costs $100,000 to do this, and I can drop your cost in half if you use my software. It just said, this is a great new platform for running M&A businesses. That doesn't do it. That's not a problem. So you got to start out by saying something that is a problem or an opportunity, and it better not be just nice to have. This is one of these that says, it would be nice if all of the advantages or all the features of Facebook and all of the features of Twitter were together. That doesn't make it nice. People don't buy nice to have. They might consider it free, and you might not want to give it away free. But in fact, the context of what you're charging is very relevant. So definition of the problem, definition of your solution in that context. Now you can talk about my solution as the benefits, cost, whatever advantages. Then you talk about how it gives that to the technology, if it's a technology thing. If you start with the technology, then you have to talk about something that investors are looking for as a sizable opportunity and a growing opportunity. There's got to be more evidence. In fact, here's a case where people don't believe you. It has to be third-party evidence, Gartner reports or something that says the market for social networking is growing at 100% per year, and here's the evidence of what the needs are. You got to quote somebody here that's not you, because you say, I think everybody's going to want one of these. That's fair. You can say that, but it isn't going to get you any credibility. So, market sizing, segmentation, opportunity growth. If you tackle a business or an opportunity that's declining, probably isn't going to help. That's just like marriage. I saw a presentation in the MBA class that said, okay, we're going to do marriage planning online. Marriage planning, great presentation on how this can be done on the internet. You know, brides spend thousands of dollars on their marriage, and they bring in these consultants, and it costs them all this money. We got this way that says, sign up online, get what you need, and we'll deliver it for half the price. Sounds good. A couple of problems. One is they happen to mention, a lot of people have raised the question, well, marriage rates are declining throughout the world. People are not ready to pay their let's focus on, there's a lot of other issues in the marriage thing that, in fact, you have to be in a business that looks like it has an opportunity to grow. So that's important. Competition, we'll talk about that. We'll talk about competitors as well as alternatives. In other words, when somebody invented the first airplane, they could probably say there's no competition, there's no other airplane out there. We're the first one. That's not good enough. You have to say, this is, our competitors really are trains or cars or whatever, we're the alternatives. And then you give your advantages. Say, by the way, if they're our competitors, we can go 10 times as fast as they do, or whatever our cost differential is. So pick somebody that's to your advantage to be your competitor, because your competition, position yourself, and so forth. Marketing strategy. This one, management. Who is on your team? Who is on your team? The reality is that every business plan I get, most investors I see, I flip to this section first. Maybe not fair, but it's true. People invest in people rather than invest in ideas. Invest in people. So if you have management, CEO, advisors, top executives who have been there before and done that, and have succeeded or not succeeded, that's a tremendous advantage. When I give this, I talk to MBA class, I say, well, that's not fair. I haven't been out there. I can't, I'm going to be the CEO, so I don't have any credentials. Well, you have to be smart about this, and that is, this is the place, if you're an MBA just coming out of school, or it's your first startup, team with somebody who's been there. Team with somebody who's been there. It can be an old guy like me who wants to be on your advisory board, but I don't want to take over your company, or it can be a hotshot CEO that's really good. In fact, his name being on there is going to get you money. That'll get you through your first round, first company. Now you can be the success, and you can have somebody else. This is the way business works. If you want to go wholly on your own, wholly with your own domain, it's your money. In other words, it's your own money, and there's no problem. You can do whatever you want. But if you want investors, you got to have somebody that has some evidence that it's a risk. It's manageable. That's all it's about. So the management credentials. In fact, one of the things I see is a lot of business plans that carefully don't mention management. That's a big red flag. It says they didn't put them in here. It's probably because they didn't really have anything to say. And so that's what I asked. Projections, very important. I'm not sure why, but this one I get a lot of kickback on. People say, well, I can't project what I'm going to do, what I'm going to sell next year or next year. And nobody's ever made the projections. My answer is, I can't give you any money on the basis of absolutely no commitment, absolutely no assertion of any confidence that you're going to do anything. This is what you think you can do. Nobody's going to hold you to that, and we know it all changes. But there are rational numbers that need to appear. First thing is, if it doesn't get to 40 million in 5 years, maybe it's not a big enough business for me to invest in with that growth rate. In other words, you project a flat line, I'm not interested. Or you project that it's going to take 5 years to get to break even, I'm probably not interested. There are all kinds of considerations. This whole thing has to be looked at from the investor perspective. What's in it for me? What's in it for the investor? What's the rate of return? And then you get into How much money do you need? You need $1 million. First thing the investor's going to ask is, how much is your company worth now? The reason he asks that is that that's how much he's going to own. In other words, if you're asking for $1 million and you can prove that your company's worth $1 million, then he will own 50% of that company. He will own $1 million, $2 million total value after the investment, post-money time. So people who walk in and say, I haven't done anything yet, but I need $1 million, they won't get it. They won't get an investment, maybe from their own firm or something. That's you say, go talk to your friends and family, somebody that believes in you beyond business, because you have no collateral, no experience, nothing. These kind of things, valuation, bring up some very important things. One of them is patents, or what kind of proprietary intellectual property do you have. You get into debates about, well, is a software patent any good? Is it even a good thing? As people say, and I sort of believe it's not a good thing. It's very tricky. I have a software patent, but I still don't really believe that the patent office can do software patents sensibly. Yet I will recommend every client get a software patent, because when you talk about valuation, that's evidence that you have a competitive position that you can sustain. And in fact, my informal guideline says every patent is worth $1 million valuation. So if you say, I got a patent, by definition, it's a round number, the bigger it is. But if you have people that are really experienced, that's $1 million. And if you have some assets, it's even more. And then if you have a projection to like $40 million growth, you do discounted cash flow, like nice accounting things, and I think this kind of cash flow of $40 million is about that present value of $4 million. So, yes. No, it's actually very easy to do the first step, which is called provisional patent. So start with provisional patent. That's a placeholder for 1 year. So if you have a concept, write it up, and you can either hire an attorney to do it for $10,000, or you can do it for $300. And it costs, I think, $100 to file a provisional patent. In terms of investors, it's probably as good. And follow up within 1 year, with a full patent application. In both cases, you need to do a little homework to say, does anybody else have prior art for all these kind of things? And you can do it yourself on the internet. If you can't find anything on the internet that sounds like your patent, then you should assert that this is unique. But you have to do your work. Yes.
Marty, is there any just general rules of thumb if you already have a bootstrapping situation and you already have some income revenue coming in, formulas times revenue, and with a certain percentage of increase in growth?
Well, each industry kind of has its own rules, and so different people have different looking at it. Some people will say whatever my revenue is times 6 or something is what the company's worth. It's a multiplier. And those multipliers are determined by industry. So you can go on the internet and find this and say if you're in manufacturing, it's 2.5, and if you're in this, it's 6. That's one way. The other way is to say, look at the revenue projection that's 5 years out and do discounted cash flow back to 1 year and present value. That's another way. I actually published an article that said, here are 10 ways to do valuation, and you should use all 10. Take the best, or it's a combination of the best. Because really what an investor knows in his heart is that nobody knows what your company's worth. Not today. He doesn't know if you're going to make that forecast. He doesn't know whether the ratio is going to be a lot different. He doesn't know whether that patent's going to get rejected 2 years from now. He doesn't. But it's evidence that there is some work being done. The way I've seen it, 2 or 3 startup failures in going for angel funding is that they get through this process that I described. They got all the right presentation. They're standing up and they've given their 10-minute pitch. And it's great. Looks good. And one one angel raises his hand and he says, "What's your valuation?" Because he's really asking how much of the company are you willing to give away for that money. And if you haven't thought about this and done some of that homework, there are 2 or 3 bad ways. I have no idea. Nobody knows what valuations are. That's just a game. That's not good. That's going to convince the investor that you're either a sucker or you're trying to fuzz it over or something like that. Or you say, my valuation is $50 million. And why do you say $50 million? I just made up the number. I mean, that's just a made up number. Or he comes up with equally bad logic. I said, well, I think I'm going to get to $50 million. It's worth $50 million. You just have to have some logic. All I'm saying is you have to look credible. I just want to stand up here and say, well, I have a patent and I think that's worth a lot. I have some assets. I've done a discounted cash flow. I've looked at the lists of what the purchase rates are. It's all about comparables. It's sort of like real estate. You know, you say, what's your house worth? You say, what's the comparable? That's where it comes from. So you have to make the case that you know what's going on. And most investors will buy it. They'll probably negotiate it. So what I say is, if you're in the angel category, you ought to be in about the 4 or 5 million range of valuation, and you won't get tossed out of your ear for that. If you say you're at 20 million, that'll get you tossed out. If you say it's 0, you won't get anywhere. You've got to be in the game, and you've probably got to be willing to negotiate. So, like one of my friends, I'd say, go in with $4 million, but if somebody says, I'll give you your $500,000, if you agree it's only $2 million, you might say, hey, that's a good deal. So even though in your heart of hearts you really don't know how to do this, give yourself a little negotiating space and give yourself some options to argue. Because this is an art, it's not a science. Good question. So this is the actual process in Phoenix, and we do use AngelSoft for. There are actually 2 or 3 angel groups in town. The biggest one is Arizona Angels. That's the one I'm part of. There's another one, Main Street Angels, and there's Tucson Angels. There's Ed used to run one of these, so he's really expert. What am I missing?
Tucson is Desert Angels.
Desert Angels, that's right. Desert Angels. And to me, you should try them all. In other words, count on this being a hard, long road. I get clients who say, okay, I'll have my business plan done next month, and then I'm allowing a month for funding, and I'm going to build it. I said, wait, just a minute. First of all, it'll take 3 or 4 months to get your business plan done unless you get some help. Secondly, it'll at least take 3 or 4 months to get funding, and it won't happen the first time. In other words, I know people who have been to Desert Angels, and Arizona Angels, and Main Street Angels, and they go to West Southwest, and they're looking at silk PCs, and they're struggling. But in fact, that's why I like bootstrapping, because it's going to take 3 or 4 months of your CEO's time, full time, just looking for money. Anytime something else is not happening, stuff's not working. So it's hard. So Lee Harris runs the Arizona Angels. He gets all the submissions, and I'll just make up numbers here. I'll say he gets a dozen a month, and maybe half of those he rejects because they aren't complete. They don't have a business plan that's got half the stuff in it, or they don't have those 4 things that I talked about. So he just says, no, I'm sorry, come back with the red. The other 6 will say, go to the selection committee on about 4 or 5 of this. And we look at them online, actually, and so we may say, no, we don't like that. This is a business that can't possibly be on. No board. A reasonable case says, I don't know any angel who's interested in that kind of thing. We get some, like this is interesting. Once in a while we get a proposal that really applies to women, like jewelry or some kind of perfume or something. Unfortunately, they're almost all men. I don't know why, but there are almost no women who are guys, they're all going to get, have no idea whether that's a good perfume company or not. So sometimes you say, I don't think we really want to waste the startup's time coming here because they're probably going to think. Now, we actually bring in maybe 4 a month, and they present 10 minutes. They get 10 minutes to make your pitch. The CEO only can make it to 5 guys that are the selection committee. You better be clean. You better be right through those 10 charts. You better not have 50 charts.
I've got some conflicting advice that presenting to an angel committee or a big group all at once maybe put you at a disadvantage because of the angel investor group think mentality. That if you have one guy who doesn't quite get it, is going to spread that. So everybody's going to say no because one guy won't get on board versus if you approach every individual every investor on an individual basis, you can make that case more personable and not be reflected based on the group think mentality. How do you respond to that?
I think you're right. I mean, there is this crowd mentality of these angels. I see it all the time. It's a trade-off. It's a risk. It's your strategy. Actually, what I do, my business, so to speak, is I would say for $1,000 a year, I'll be on your advisory board. Means you put my name on all this stuff, and I can get you through this. But if I actually say if I've done my job properly, I will put you in front of the 1 or 2 angels that meet your needs. And in fact, a good job means you don't go in front of that group. Because here's what happens. This is about this size room. He knows it too well. As soon as the CEO presents 10 minutes and we kick him out of the room and start talking about it, everybody looks around and says, anybody know him? Anybody know anything about this? Well, somebody knows something about it, good or bad. That's what's going to take forward. And they say, well, does anybody know anything about this business? Using software. Now, I happen to know a lot about software, so Marty, what do you think of that software? Now, maybe I don't like it because of something totally wrong. If I say, no, that's not a good deal, it's wrong. Single sign-on has never made it. It's like, I don't see this really here today. It's just real. This is real. No, I'm just trying to help. And, on the opposite side, if somebody stands up and says, I know this guy, I know this deal, this is a great deal. Now, everybody's like, okay, maybe I should be thinking about this.
So it cuts both ways, what you're saying.
Cuts both ways. So don't go in totally unknown. That's not a very high probability of that. Ideally, you will have met or gotten support from 3 or 4 person through your connection indirectly. Now your odds are pretty high. It's all about odds.
How accessible are some of the individuals? I mean, are some more open to meeting on a one-on-one basis, others not? Or?
Yes, I would say in general, everybody is accessible. You should assume if the guy says I'm an angel investor, by definition he's interested in a deal, a good deal. He's not interested in being spammed. He's not interested in talking me into the wall, kind of thing. Here's what I get all the time. Because I'm on Twitter, and so forth, that people send me a note that says, I need to talk to you. I have this greatest idea since sliced bread. My standard answer on Twitter is, send me your business plan, because I need to do my homework first before we talk. Half of them say, no, I don't want to do that. I just want to talk. And I don't want to talk to them because people will talk for an hour, and I have no idea. They're all over the map. In fact, typically they're not sure what they're trying to do. They're fishing, and it's a waste of their time and my time. So if I say, send me your business plan, it's really more like, I want to see if you've gone to that extent to find your business. And it's not a point to the extent that I can read business plans very fast and I'm looking for all the red flags. Now, if I see their business plan and I like it, and I've asked for it, I'm interested. But if I get emails with business plans attached that says recipients unknown, that says they're doing an email blast does not work. Those get ignored by definition. You've got to do some pushing. Yes.
Throughout, you mentioned that as an English, you're going to come to me and say, I'm going to put my own management team into your company, therefore I want my own CEO. That's the way that's what I found through management school and all of this. So the CEO presentation, the selection committee is going to be me. I then think, okay, I want you to be the CEO. And it's the proper is it going to show judgment that you're now making the presentation of the monthly meeting, that I'm willing to say, look, this person's going to do a better job running it. I'm the idea guy. You're the CEO. You're the man.
Well, it can be good or bad. If you really intend to bring somebody in as a CEO, then you shouldn't hide that fact. You should tell them, I'm planning to bring in, my strengths are, I'm the idea man, whatever. At the same time, we will demand that the current CEO is the one that does the talking. Because I have a strong feeling that there has to be one person in charge. There has to be someone in charge. We often get teams where, like two brothers or something. Somebody says, okay, who's the boss? Who's the boss? And they go, well, we kind of share this. That's a bad move.
That's my brother.
Hey, that's right. It isn't a reflection on any individual. It's a reflection of we need one guy that says the buck stops here, person. In fact, in general, I think they're not here. We would probably frown on husband-wife teams or even two brothers as a team because, unfortunately, in history, an awful lot of breakups occur because of family issues as opposed to business issues. And so it reduces the risk. The guy comes in and says, well, my wife is my partner. By definition, they're already in trouble. Again, if you got your own money, no problem. You got your friends that have money, no problem. If you're looking for outside investors, I'm just giving you a bias or factor.
How do you find and select a CEO if you're a tech guy or an idea guy and not a business guy?
See, the standard answer I always give is networking. That means you've got to rely on somebody. If you're here, you go to somebody like Ed and you say, who could be a CEO? And he goes to his friends and people find each other. That's the way it has to happen. That's why social networking is good. It does work.
But I mean, in the same way that you talk about guidelines of things you look out for when you're looking out for somebody who doesn't have their head screwed on, with for example, a business plan, is there not an argument that there should be a list of things that you should look out for to find out whether you're actually talking to a business guy who is a business guy who doesn't really know what they're talking about, but has managed to sell you thinking they know what they talk about?
It's too bad that everything you see on the internet can't be believed.
Yeah.
So that's true in real life. That's what networking is all about. It's like, if somebody in the angel group thinks he likes something, he turns to somebody he knows and says, do you like it? Do you know anybody? Do you know this person? It's all people to people. People are still people. And they make very emotional decisions. They make very wrong decisions based on that in retrospect, but that's the way it works. I was kind of naive. I think a few years ago I said, well, if I get this process down right, I could make this happen. If I start up, will get funded, it doesn't matter. Do I know anybody? I'm kind of an introvert myself, so I don't like to go to meetings and meet people. So when I found out it doesn't work that way, it just doesn't work that way. So these things like Invest Southwest, which we have here, we have several hundred people. I go kind of, I hesitate to go to that night before, wine and cheese thing, but I got to go meet some of these guys just to kind of see who's there. So I come and go. You have to balance these things. You get a partner who's a schmoozer, and he meets everybody, so you do real work. You got to divvy up the work somewhere along the line. Send out your marketing guy to do all that connection kind of thing. But once you get in front of a committee, and you get in front of any kind of funding venture capital. They're judging you. They're looking. They say, I want to look you in the eye, see how serious you are. I'm going to ask you questions that are known to be hard questions. How much skin do you have in the game? See, a lot of people have worked with no salary for a couple of years. And so they say, well, I put $300,000